Guys, welcome to another video. Cadro Trade here. How have you guys been? So in this video I wanted to explain how to identify different types of liquidity. Once you understand how liquidity is being generated and how liquidity is being taken out, you're going to be well ahead of 99% of traders. So in simple terms, what is liquidity? Liquidity means money in the market. Simple. I don't want you guys to complicate this thing. You guys have watched my first video, my second video. I try and simplify everything in a very simple format that even a 5-year-old could understand what I'm saying. So liquidity simply means money in the market. This is where the money is sitting. Okay, let's say now there's liquidity. Liquidity means stop losses, pending orders, buy and sell orders, sitting above or below a key level. Big institutions use liquidity to fill in their orders because big institutions are trading billions of dollars and they need liquidity to fill in their positions. They have billions and billions of dollars and almost trillions of dollars. So they can't just come into the market and enter a trade. So they need to fill in their positions. So they have to use the liquidity that is available to fill in their large positions. Okay. So this is just a theoretical explanation of liquidity. So let me just show you guys. Let's say in a bullish market, when the market is going up. In a bullish market, when the market is creating a series of higher highs and higher lows. Now, you often find trendline traders entering their trades like this in a bullish market. Yes. Basically, what they do, trendline traders, is they keep drawing this line. So anytime price touches this line, they'll enter their trade. Let's say they're in a long position from here. They enter a long position here. Their stop loss will be below the trend line here, and then they'll enter again here. Stop loss will be below the trend line here. They'll enter a trade again here. Stop loss will be below the trend line here. So basically, they're drawing this trend line and entering a trade whenever the price touches the trend line or break the trend line, because they believe price is respecting it. Since price has respected it once, twice, 3 times, 4 times, price is always going to keep respecting it, and that's the trap. All these things is price engineering liquidity for the main move to happen. Smart money traders know where all these liquidities are positioned in the market. So when price break, it's not a breakout, it's a liquidity grab. So let me just quickly take this thing out. So whenever you see price respecting the trend line, first touch, second touch, third touch, fourth touch, and then what are trend line traders expecting? Since all they do is draw a line and follow the line and expect price to respect each time price touches the trend line. That's it. That's their strategy. Now, price is here and they have drawn their trend line. What are they expecting? Price to come here, tap, come here, tap, continue going, respecting the trend line. Yeah. But the market will not just move like this. The market will first engineer liquidity and take liquidity out. So you see something like this. This is in a bullish market. This is in a bullish market here. Price will come and take, because we know that all these trendline traders here, their stop losses are what, as I illustrated earlier. Their stop losses are here. 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 And I describe the big institutions as people that need liquidity to fill in their position. So all this liquidity that is being generated here, you see the market come to take all of it out and then move up. And people will start thinking, okay, the market is bearish. Nah, the market is not bearish. This was just a grab of liquidity to continue the trend up. Now, Oftentimes when you say trend line liquidity on the chart, 80% out of the time, it's always going to get induced eventually. Don't get me wrong, sometimes it might get respected, but as a trader, you need to have an edge that differentiates you from everyone else. Do you guys understand what I'm trying to say? You need to have an edge that differentiates you from everyone else. So, you trading trend line, I know a lot of people that I know a few people that trade trend line and they are profitable. A few actually that trade trend line and are profitable. But most of the normies want to come and start trading trend line because they think it's easy. It's not easy. You get me? So this is the first type of liquidity I want to explain to you guys because it's easy. Basically, you can see that price is respecting this line here, and then you see that price will come and take everyone out, take out their stop losses, and continue going up. And then we have support and resistance liquidity. This is what we call trend line liquidity. Let me just put it here. Trend line liquidity. This is what we call trend line liquidity. And then we have support and resistance liquidity. Support and resistance liquidity. This is what 40% of forex traders trade: support and resistance. Support and resistance liquidity. Resistance, okay. So it's basically almost the same concept here with support and resistance. Just that support and resistance is not in a trend line format. Retail traders buy as support and sell at resistance. So basically, this is what they believe. Let's say the market is respecting a certain level, a key level. It is called a key level. The market is respecting a key level. Let me just quickly illustrate this in here for you guys so you can see. So whenever price taps into a zone or an area multiple times, it is called support. And now we can see that what? First touch, second touch, third touch, fourth touch, fifth touch. So retail traders buy at support and they sell at resistance. So basically this is called support. It's called a support level. And then whenever they see price respecting a certain zone or a certain price or key level, they just tend to buy, and then their stop losses will be here under this zone here. Stop losses, because they believe that price has respected this zone once, twice, third time, fourth time, and fifth time. They believe that price is going to keep respecting it, but at the end of the day they end up being liquidity because you always see a breakout, the market doing something like this and continuing bullish. Always happens. Used for support. And then retail traders sell at resistance. Same thing again, but just inverse it. The market is going to tap in once, twice, third time, fourth time, fifth times, and it's called resistance. Whenever they see the market respecting a certain zone, once they enter a short position here, they'll sell. The stop loss is above. Go again. Stop loss is above the zone. So basically, this whole area is liquidity, and what you see that always happens is the market comes, takes them out, and then the real move happens. Let me see if I can illustrate on the chart for you guys so you guys can understand properly. Yes, here's a clear example of support. You guys can see that price tapped in once, twice, third time, fourth time, fifth time, sixth time, seventh time, and then what happened? As I said, guys, as I explained to you guys, what happened? The price took them out when they were expecting, gave them a little bit of reaction here, and took them out, and then the real move happened. They're taking out all this liquidity here. That's how it works, guys. Market will always engineer liquidity and take it out. And the way the price respected this level of demand here. And then let me give another example of trendline liquidity here. Trendline liquidity. So here we can see that price is respecting this level here. Let me just zoom in. You can see the price is respecting this level here. You can see the price tapped in once, twice, third time, fourth time, fifth time. Where were they expecting retail traders for price to respect for the sixth time, and then what happened? Induced all the liquidity, and then the main move happened. You can see how price dumped since taking all of this liquidity out. This is to show you that this is manipulation with intent. Use an example of resistance. What can we see? Price tapped into this area once, twice, third time, fourth time, fifth time, and then boom, what happened? Took them out because buyers are now in control. So the moment you start understanding how liquidity is being built up in the market and how liquidity is being taken out, you're going to be ahead of everybody. As you can see, trading the retail will, because I've also traded retail format, and I'll tell you that it's not profitable. For a fact, there's a whole lot of garbage, a whole lot of nonsense. But yeah, and then now let's move to what we call the smart money type of liquidity, because smart money traders think that because they don't trade the same concept as retail traders, trend line or support and resistance or whatever, they believe that they're better than them. So let me explain to you guys how the smart money traders trade. Basically, since they believe that price is going to engineer liquidity and then take it out. Let's say now in this bullish market, now we have a trend line. Pardon my drawing, guys. Let me just draw that again. Since they believe that in this bullish market, price will not just keep going up, price will have to engineer liquidity and then take it out. So what smart money traders, people that trade pure smart money concept, do is they wait for price to finish building up liquidity, and as you can see, this is all a build up of liquidity, trend line liquidity that price will later induce, as I showed you guys. Then what's gonna happen? Smart money traders are waiting for this liquidity to get taken out. Boom. Which is called sweep of liquidity. Smart money traders call it a sweep of liquidity. And then when that happens, they'll then wait for a confirmation and then get into a buy. Yeah. So when there's a build-up of liquidity and there's an inducement of liquidity, which means taking the liquidity out, a lot of smart money traders see that as an opportunity to get inside the trade without understanding who's in control of price. So there's a build-up of liquidity, criteria number 1 met for smart money traders. And then there's a sweep of liquidity 2. And then there's a change of character and a break of structure. Smart money traders will be loading up for a buy here with their stop losses below this zone to target the next high. This is how smart money traders trade. But smart money concept doesn't work anymore if you just trade only smart money concepts. You have to identify who is in control. So what usually happens if you don't have timing, if you don't have inducement in your side, price will give you a confirmation, change of character, whatever. Some money traders will be loading up for a buy in this zone here because they believe that liquidity has been generated and liquidity has been taken out. Now the real move can happen and they have confirmation, they have whatever. Usually what happens is price will come, give a little bit of profit, take out the smart money traders. I think they are also smart, which are also retail traders, by the way, and then boom, the real move will happen. This is how it works, guys. So you need to always understand who is in control of the market. And in this channel, I'm going to teach you guys how to identify who is in control. Because the moment you start understanding who is in control, which is inducement, you will be ahead of 99% of traders. This is what I was able to do that took my trading from a beginner trader to a professional trader. Yes, guys, so I think this video is becoming too long. I'll continue in a part 2. See you guys.